Welcome to the Millennial Money Moves podcast. On this episode, Blake and I are diving into the basics of investing. We really wanted to set a good foundation for the listeners out there so you know when we talk about a stock or a bond or use the term equity and fixed income, that you know exactly what that means. We also wanted to highlight, again, the importance of the investment options in your 401k plan, as that's where most of us build the bulk of our wealth. We hope you enjoy this episode. This content is purely educational and is not intended to be financial advice or financial planning. Please consult your professional financial advisor or tax professional to receive tailored advice to your personal situation. Babin Wealth Management is not responsible for action taken by listeners based on educational content provided. If you would like to receive personal financial advice, please reach out to Babin Wealth Management directly at babinwealth.com. Let's make moves. Welcome, everybody, to another episode of the Millennial Money Moves podcast. I'm your host, Sean Babin. With me, as always, Blake Bandani. Good to see you, Blake.
The one and only. What's going on, Sean?
I love the one and only. I think
You
that's
got to
going to
do
catch
it.
on.
I've done it every episode. I can't stop now, right?
Megan was like, "Oh, the one and only, huh? Okay.
I need some hats and T-shirts for that phrase now.
Yeah, dude, you should. We'll get it. Well, actually, that could be like Babin Wealth Management, the one and only.
I'm gonna have to trademark that, but good to see you, buddy.
Yeah, we'll give you some royalties off that deal for sure.
Appreciate it.
Good to see you too, man. Glad to be back at it again. This is our 8th episode, dude. How cool is that?
Look at us.
I read a stat that 90% of attempted podcasts don't make it past 3 episodes.
Hey, round of applause.
We did it. So yeah, man, this is going to be a fun one. I'm going to actually let you kind of run with the intro, kind of switch seats a little bit. And, you know, you've explained to the listeners what we're trying to get after into this episode. I can't wait to get peppered with some questions. Let's have some fun.
Well, that's why we're doing it. On a side note, hopefully people took some advice and maybe dived in a little bit into the market here, even in a down market when there was a fire sale, because this is the time to buy. Am I right?
Dude, it's been wild. It's been, 3% up, 3% down,
Crazy.
3% up, 2% down. It's been an interesting week since the last time we met. Good though, it hasn't gone like any crazy lower, but it's gotten a little better. But yeah, I think we hit it like nail on the head there. Like in those panic moments where you want to do exactly the wrong thing, just kind of close your eyes for a week or two, maybe a month or two. It inevitably just kind of that anxiety or frightfulness of the country just kind of goes away, and we all kind of just like move on to business as usual.
It's crazy how that works, huh? But knock on wood, it doesn't get any lower here. So,
Yeah,
but hey, what I wanted to do for this week is, obviously we're talking on these podcasts, but I'm also listening to them, and maybe I'm tuning my own horn here, but I think we sound great, of course. But I think it'd be good to maybe slow it down. And some listeners may not have any investment background, any exposure to our industry. And I think we toss out a lot of terms. The easy ones you can stay along with, like the market. What's the market doing? What's a down market? But I thought it'd be pretty cool. And just listening to you and how you approach your practice as a financial advisor, just getting it from your perspective of like, what are we really saying? What are some of these terms that we toss around that really don't second nature to us, but maybe to a listener, they're like, what are they even talking about? And I think that maybe it would be awesome to unpack a little bit of that and dive into it, because again, I feel like you've done an awesome job of really showing our listeners the lens of a financial advisor, but some of that terminology can get a little confusing. What do you think about that?
No, I love it, because you're right. And like in my client meetings, I ask people like, hey, all right, tell people, hey, this is your time. So if I'm talking over you, or if you're not understanding it, like you have to slow me down and ask me. It's like in class, like don't be scared to raise your hand kind of thing,
right?
If you're not understanding what's going on. So we obviously don't have that kind of feedback. So you're right. I think we get very comfortable in our acronyms and our, jargon that we use every single week. And so, yeah, I'd love to just take a step back, go a little bit deeper and clarify. I would imagine some of it is like, what is a stock? What is a bond? We hit it on the last one. You made me put $1 in the jar. Asset allocation.
Exactly.
Slow me down. So yeah, I love it, man. And I'm gonna let you run with it, buddy. Yeah.
And to your point too, it's like in this podcast setting, we're not looking at anybody, but in a traditional meeting, when you're sitting across someone, or maybe it's a virtual call as well, like you can tell when you're kind of losing them, right? But we can't really see that here. So I think the first thing I wanted to pick your brain on and start with is we talk a little bit about when the market's down, it's a good time to buy, right? Well, we always use the term buy and just buy into the market, but like, what are exactly we buying into? I think we should start with, right? Because there's a lot of different ways you can take advantage of that down market. And I think when we talk about buying in, maybe we're just assuming our listeners understand that, but are we saying buy into specific companies, which AKA, correct me if I'm wrong, stock? Or what about buying into our other favorite term, mutual funds, right? Like what let's unpack that a little bit and really dive into what that all means. When we look, and me personally, I look at the Apple stock app, right, on your iPhone. You see these greens and you see these reds and you see these down percentages, and typically they're showing you the index to specific companies, right? So if Apple is showing you down 10% in the red, right? Part of what we've been pitching is, well, maybe it's a good time to buy specifically Apple stock. Is that fair?
Potentially, yeah. I mean,
Of
I'm
course.
not one. I won't on this. Yeah, it's gonna be tough for you to get me to say like buy a stock, like buy a specific stock. So general themes, but yeah. So like, yeah, when something's down big, hey, does that make sense? I don't know. Yeah, we
Well, yeah,
buy
and I'm
into
not
it.
saying like, hey, Sean, tell the viewers they should be buying these specific companies. But in the hypothetical scenario, when we say buy into this market when it's down, you have some options of what you can actually buy into. Whether you trust Apple or Google or Tesla, I guess my point of the question is like, there is a potential where you can buy specific stock of those companies so that when those markets turn around for those indexes to those specific companies, you bought in at a certain value of that company and now it's flipped upside down and now it's positive again. So you almost just gained equity from that. Is that fair?
Yeah, exactly. And I think what we're gonna hint here is kind of the overall theme of the whole podcast is there's so many options, there's so many things to do in these moments. Do I just buy Apple? Do I put, that money I have in savings into Apple, just the stock, the company, that as an individual, or do I put it into an index fund, or do I put it into a mutual fund, or that is like there's just so many different options of what to do with your money. So yeah, I love where we're going. It's going to be tough to unpack because uh it's just tough. There's too many
Yeah, no,
options. So
for sure. But I guess to the point of that is like what I'm getting at is like you don't necessarily have to buy a specific company when we say maybe it's a good time to purchase in a down market. There are things out there called mutual funds or ETFs, right? So I'd love to unpack a little bit about, well, what's you can't use the term safer or guarantees, but the idea of these mutual funds versus buying specific companies is that these mutual funds are managed by specific fund companies, but you're basically buying into that fund company and their money managers who decide what companies they are actually purchasing within that mutual fund. Is that fair to say?
yeah, exactly. And so that's again a tough thing from a consumer standpoint is hey, I know stocks are down. Do I just buy into Apple? Do I put this into this mutual fund? Do I put this into this ETF? And so even an ETF and a mutual fund aren't as just simple as like, hey, this is a mutual fund. It could be a passive index fund where it's just following a certain index. It could be an actively managed mutual fund, meaning the managers of that mutual fund are trying to outbeat said benchmark that they made up. And a benchmark is an index. So, some people out there believe that they can outbeat markets, that they can manage a fund that will do better than the S&P 500, and they're going to try their damnedest to do that. So yeah, man, it's a loaded question, but yeah, keep going with it. Is that
Yeah, yeah. So
helpful or is
like,
that a little
let's
too
pause
much?
there. Let's pause there. Like a passive index, right? A lot of times, a novice or a beginner investor is going to hear this term S&P 500, right?
Hmm.
Oh, just put your money in the S&P 500. Don't look at it for 40 years. Well, what are you actually putting your money into, right? And that's, to your point, a passive index where you can track and follow these top 500 companies in the US. So now you're not just putting your eggs in, let's say specifically buying Apple company stock. Now you're buying into these mutual funds that behind the scenes are purchasing Apple, they're purchasing Google, they're purchasing Amazon. So it almost makes you feel a little bit more less risk averse because now rather than just going all in on a specific company, you can follow these mutual fund companies that purchase these companies behind the scenes and you kind of see the benefits of that, right?
Exactly. Yep. You're owning all 500 companies and they're, different. They're weighted differently. Like the largest ones are obviously more over, you're owning more of that than the small, than the 500th largest one. And that's how
Right.
index funds, they can be price weighted, they can be market cap weighted. And so, yeah, you get to own that whole basket of those 500 stocks. And what I love about that is you don't have to go pick these things. They're picked for you. And if they fall out of favor, meaning if you buy into that 500th company and the next year, that year it doesn't do well, when it falls out of the top 500, then whatever replaces it, you're kind of buying back into it. So it takes kind of the guesswork out of having to pick stocks, certainly. But yeah, it narrows the range of returns too. So you're not going to have as much upside if in an index fund versus just saying buying Tesla or Apple, for example, but you're limiting your downside too, because you're casting that wider net, having that diversification.
Right. So again, even in a down market perspective, maybe you don't necessarily have to go in, and we keep picking on Apple, but I mean, it is one of the largest companies in the world. But maybe you're not comfortable just putting in $1,000, $10,000 into Apple specifically, but there are mutual funds out there that will have these portfolios that include Apple stock as a majority of it, but also maybe have some other sprinkled companies. So you're not just relying on Apple to turn it around. You can have some eggs in another basket with other companies, right?
Exactly. Yeah, you'll have companies you've never heard of. You'll be buying into a company like Nvidia well before it's
Bingo.
Nvidia potentially, and then you'll get rid of some companies as they kind of fall out of favor too. I think that's the most fascinating thing, I think, with the stock market is like no one is king for forever. There's many examples of companies that you thought would last forever, and then times change. I mean, Kodak is one of the ones that we use a lot of times in client meetings. Like shit, back in the 80s and 90s, like you thought, the camera was the thing, like everyone was going to obviously have one, and that company couldn't be replaced. And then boom, an iPhone came out, or a flip phone with the camera came out, and that thing just went into bankruptcy. And that kind of allows you to kind of limit your risk for sure in owning kind of a broad basket index like an S&P 500, and you can buy them in an ETF or a mutual fund. And if you want to get into those differences, we absolutely can too, because they're pretty similar, but there's some little nuances to those different vehicles and different investment purchases.
Absolutely. So that's to that point, though, you hear a lot of times, like, especially if we're getting a lot of millennials here, right? Well, you have time horizon, just stay focused, locked in on equities. Well, what are they telling you? They're telling you keep purchasing, not necessarily stock of companies, but keep being aggressive with buying these types of funds that are backed by these huge companies. Because over the next 20 years, hopefully those companies continue to grow as they've already shown in the previous 10, 15. So if you hear that term equity exposure, we're just implying that you're actually putting most of your investments into companies that not everything is guaranteed. Maybe that company does go belly up. So you're taking that risk. But when you use some of these large companies that have created a footprint that really show the consistent trends year in and year out, you're kind of tying your investments to those companies, AKA investing in equities. Did I say that fair as a novice investor myself, or what?
Yeah. Anytime you buy stock, you're now an equity owner in said company.
Right.
Even when you buy a mutual fund or an ETF, which owns hundreds of different companies, that mutual fund or ETF is a shareholder of all those different companies, and you are therefore a shareholder too. So yeah, that's the whole point, is that's what's really driven the entrepreneur, which is business owners, drives capitalism. They drives growth. People inventing things, fixing problems that we have, and turning into bazillionaires because of it. And if you are a part of it, meaning an equity investor, then you should make money off of the entrepreneurship backbone or capitalism backbone of this country. And it's proven for the last 100 years that is a really healthy way to leverage your money.
Exactly.
The S&P 500, again, we use it. I know we use it all the time because it's what most people understand, the largest 500 companies in the US. That's averaged a little over 10% since its inception, going back to 1923. So that is a heck of a return for, I wouldn't say the average person, but people who are just trying to build their wealth. There's a lot more speculative ways to make a lot more money, but if you can dump money from your 4K, your paychecks into a vehicle that can do 10% a year long-term average, then that's a heck of a way to double your money every decade. And that's the whole point of being an equity owner. Now, you're right. It does come with risk. We've seen it this year alone where, you could be down 10, 12, 15% in a couple of days if kind of the shit hits the fan, so to speak.
Yeah, well, and exactly right? Like new administration, we're going to hammer tariffs. Apple manufactures a lot of their products overseas. So now there's going to be a huge hit to their sales volume now that they're expecting less consumers to want to buy Apple because they're going to have to hike the prices of things now that there's tariffs involved, right? So that's kind of the idea of like you're taking the risk by putting money into these companies, and administration, regs, laws, they can turn things around. So if you're expecting this money today, it's a little bit more of a gamble because who knows what can happen. Another aspect that I love that I think has gotten a lot of popularity is this QQQ. I think it's technically an ETF, right?
All the commercials from the
QQQ,
NCAA tournament.
Invesco. And it's actually a pretty cool concept though, because from my point of view as a novice person that doesn't look at the market, doesn't really trade on a daily basis, is, Nvidia sounds pretty cool, right? And we know tech is the movement, right? With AI and where we're going with our society. But do I really want to trust Nvidia? I don't even know what I'd be putting my money into. So then these mutual fund companies and just money managers create these funds that not just put all their eggs in one tech company. They go out and they kind of observe some of the top tech companies, and now you can put your money into that portfolio, right? So it's, again, that aspect of there's nothing wrong with going in and buying Nvidia, Tesla, whatever you want, but then QQQ, that money manager is actually looking at the entire market and saying, well, Nvidia looks strong, but what about these other tech companies that you may not know about? And now you're kind of diversifying your investment rather than just putting all your eggs to one company, right?
Yeah, and like the whole investment landscape is extremely commoditized. So what Blake is alluding to is what we call a sector. So the technology sector. You can buy a financial sector, you can buy a utility sector, you can buy into the energy sector, you can buy into the consumer staples sector, consumer discretionary. Like they've segmented stocks in so many different ways that are more consumable, meaning like more attractive for you to purchase. But the whole stock universe is in the US is probably 3,500. Let me Google this. I'm actually curious now. How many? All right. So there's currently about 4,300 publicly traded companies in the US. So that's not as many as I think people might assume.
Well said.
Especially when there's so many different things you can buy. There's far more mutual funds and ETFs in the marketplace than there are publicly traded stocks. So let's do that. Let's look that up too. Okay. So here's, as of 2023, there were over 3,100 ETFs in the US alone. So almost, and that's just ETFs. If we did ETFs and mutual funds, let's see, looks like over 10,000. So 10,300.
Crazy. So now you're sitting here as an investor. Where the hell do you start, right?
Exactly. And that was my job for a long time when I was working as an analyst, was it's taking screens of all those different ETFs and mutual funds and trying to figure out which ones best fit for our clients, which ones were the most cost effective, which ones had long time, track records, didn't just pop up in the last couple of years, which ones had the performance that matched kind of what the index are trying to. There's a whole bunch of due diligence that goes into it. But like the Qs that you mentioned, the triple Qs, what's their line? Like the future might be scary, but not investing in it is even more scary. Something like that. Like you didn't hear about the Qs 10 years ago, and that's because technology stocks have done so well in the last decade that fund just makes so much money hand over fist that now they've got commercials all over the town. But yeah, it's a tough landscape to navigate.
It is, but again, back to the whole idea for like the novice investor, like you hear these success stories of like people that owned Microsoft in the 80s and they stayed on.
Forrest Gump buying the Apple, like getting the check.
Exactly.
We put our money in some fruit company, and like that line always kills me.
But that's the point, right? Is like, well, if you're not too worried about tapping into this and needing the cash, why not ride the wave and see what that money looks like by investing in that company that you think has potential growth, become the next Microsoft, Google, etc. And that's the risk you're playing, because there's also a lot of companies that don't make it. So that money that you were pumping into them from a stock purchase, if they go belly up, there goes your investment. So that's where it's like, it's tough to maneuver that as a novice investor and want to put money into that. But that's where the idea of like a mutual fund comes into play, where you don't have to just put it all into one company. You can spread it out and have these money managers that do this for a living track that for you, right?
Yeah, and I think when you're first starting to invest, that's what you think it is buying 5-6 stocks, and you want to be successful. You want it to, pop. You want it to make you a bunch of money, and so, typically, like I remember starting out, like I only had a couple $1,000, and well, shit, if I was going to go buy 10 stocks, like then I can only put like $100 in each one. So it's like, I've only got 1,000. Like, let's just pick one and put all my money into it, because I don't want to diversify this $1,000 across 10 different ones, because they collectively might not do as well as this one individual. And we're just wired to think like that.
Right.
We want those in the equity space. That's where we're trying to make money. That's where I'm trying to make my clients money. And that's where we have many of those stories of people who have hit it big. And we want to be that next success. We want to pick the next NVIDIA, the next Apple, the next Microsoft, and the next Tesla. And we think, we get ideas that that this is the one, or you work for that company, something like that happens, you get very emotional to it. And like you've said, Blake, more times than not, it's not the case.
But then switching gears, because you'll hear a lot in our industry, fixed versus equities in these portfolios where you can invest into these mutual fund portfolios that help diversify. So you're not just all in on equities and buying company stock, but also getting more of a conservative, if you want to say, guaranteed returns with the fixed income sleeve, right?
Exactly. Yeah. So, and this is our asset allocations
Let's
conversation.
get into
So,
it.
how much, stock is your equities, or your, the owning these individual companies. And then what we call fixed income is kind of your bonds portion of your portfolio. And this is you're a debtor now. So a bond is, let's use Apple again. They don't
Yep.
issue debt because they have so much cash, but let's say they issue debt and they say, hey, we're gonna issue some Apple bonds. We're willing to pay you 4%, because that's the market rate, if you give us $1,000. So, they could be a 1-year bond, a 5-year bond, a 10-year bond, a 20-year bond, however long. But every year they're going to pay you that 4% on how much you buy into those. You look at different qualities of the companies. Apple is going to get away with only having a low interest rate versus some unknown companies or a
Bingo.
little riskier companies. They're going to they're going to pay you more, because it's going to take more of a risk for you to give your money to them, hoping you get it back. So they might have to pay you 7% versus an Apple that can only pay you 4%. So in the bond space, it's very much, that's your safety net for your portfolio. We tell people the stocks are your gas pedal, and then your bonds portion, that's your seatbelt. So like when the gas pedal is broken, or we go off the gas, like you've got your seatbelt there to kind of keep you in. And that's where, we kind of transition people over time, is to that fixed income space, reducing the risk of their portfolio as they get older, as they get closer to different goals, whatever the case might be. We kind of reduce that exposure to stocks, because they can be volatile, as we've seen in the last month, whereas the fixed income typically holds up pretty well unless rates are rising. And that's a whole different conversation about
That's another time.
how price changes in fixed income works. But
In your example, you used corporate bonds, right? But what about, you'll hear the term T-bills, or what's the government bonds, right?
yeah, treasuries, T-bills, the Ginnie Mae and Fannie Mae, like mortgage-backed securities, kind of debt instruments too. So yeah, the U.S. government issues tons of debt, as we know. We're all well aware of that. Portfolio managers buy them. A lot of my clients own a lot of them. Like, typically they should be the safest investment in the world. That's kind of what they've touted themselves. They're all backed by the dollar. They're backed by the full faith and credit of the U.S. government. Under normal circumstances, that's like, pretty much it's as good as gold. So they're very safe. That's why a lot of people buy them. They don't yield a ton. Right now they're maybe at 3.5, 4% on like 4.6 on like a 10-year. And
Yep.
then versus a corporate bond typically will pay a higher yield. So when we're talking about yield is just what that company is willing to pay you for them to borrow your money.
And if I'm an investor, I hear, well, okay, the government's saying if you give us $1,000, we'll return 2% on that over the next 10 years, right?
Yeah, they're going to pay you 2% every year. That's typically stated as an annual rate. And then at the end they'll give you your $1,000 back. So you're going to get 2% every year for however long that term is, and then you're going to get your full money back in that last year when it matures, is what they call it, when that instrument matures.
Right? And then, so that's the key, because if you are closer to retirement and you're not going to be making income necessarily, who knows, but you're not your traditional job anymore. it is almost nice to say, well, I don't want to play around with a down 10% market, up 3, down 5, down, all throughout the year when I can just get this guarantee from our government that, hey, I give them this $1,000, I'm going to get this returned safely. And the idea is, well, why does the government issue so much debt? Well, there's a lot of faith in that. If the government can't pay back its debt, there's, again, bigger fish to fry than your retirement, because something's going wrong with our country. But that's the idea of that being conservative and safety net. Is that fair?
Yeah, that's exactly it. So like if people are relying on their investments to live off of, they're in those retirement years, taking that monthly distribution from their accounts. That's why we go from like maybe all equity portfolio to like a 70-30 split, meaning 70% stock, 30% bonds. And that 30% in bonds is kind of what we're pulling from each month for them to live off of. So we can live with the volatility of the stock market in 70% of the account, but 30% we're like, you know what? We need this to be here for us. We're taking monthly income. And then if 30% gets too low, like they're withdrawing and now it's gone from 30 to 20, that's when we do what's called a rebalance of their investment account, and we'll sell the
Beautiful.
stock to replenish the bond portion of that portfolio so they can continue to keep withdrawing. But yeah, we've basically removed 30% of the of the growth portion and put it into that seatbelt or safety net portion so they can comfortably live off of it. And that's what, in these volatile times, we try and remind people, like, that's why we have that there. Like, it's set in place for you to keep taking your money. Yes, your account balance is lower than it was 2 months ago, but we still have this portion over here for you to live off of for the next year or two.
Well said.
If nothing happens or if it keeps going down, you'll be fine. So yeah, that's how you reduce the risk
Of the market.
of taking the full blunt of kind of the volatility of the market, is adding more fixed income products to kind of offset the volatility. Because
And hey,
typically when the stock market, no, go for it.
I was saying, and there might be some 40-year-olds, mid-30s that are like, hey, I kind of want to just start pulling out, it is what it is. But that's why the common sense here and the rule of thumb is, well, in your early age, if you're not really anywhere near retirement, why do you need so many guarantees when you're going to be missing out on potential huge market gains? So what's a 4% return or 2% return on a government bond when the market just skyrocketed 15%? Why would you want to give up that potential? Well, because I might have lost. Yes, but you're not relying on this money. So let it ride out. Back to our podcast before, is like when you start getting to that point in your life where now you need to start thinking about how you're going to take income every year, you're not going to work as much, then there's the conversation. But again, I don't like to give any guarantees, but if you're not relying on that, why even put any money into some of these fixed income, portfolios, right?
Yeah, it's reliance on it. It's also goals related. So people maybe in their 30s and 40s who have invested for the last decade, maybe to buy a home. It's like as you get closer
Good point.
to that purchase date or closer to whatever you need those funds for, that's when you should be dialing down the risk. Like we do it for kids in their college savings accounts. Like when they start young, under pretty much 12 years old, we're investing very aggressively in those college savings accounts. But when they are become a senior in high school or junior in high school, we're dialing that risk down dramatically because we know they're going to need that money for the next 4 or 5 years to pay for that college tuition. So yeah, it's goals related, it's retirement related, it's all about, again, that's all investing is. There's a goal behind it. The most basic is to make money, but what are we making money for?
I love that.
And that's what you have to connect the dots with when you're trying to figure out how much risk you're trying to take. If you've got so much money that the reliance on your money is pretty much zero in your retirement, or you can fund all your goals and you want to take 10 grand, 20 grand, 100 grand, whatever that means to you, and go pick and have fun with stocks. We tell people that all the time, but we don't allow them to do that until we know that they're going to accomplish everything that they've told us they want to accomplish financially. And so when they get to that point and they're like, you know what, I want to have some fun, I want to go pick some stocks, and we go, okay, here's an account, here's 50 grand in it, knock yourself out, let us know when you're bored, we're done with it.
Right.
But
no, that was great, because that was the idea of this episode, is like, you hear people talk about fixed and equities, but like, what are you actually doing? So hopefully the viewer after that can kind of see the clearer picture of, okay, equities, I'm buying stock typically, and then fixed income, I'm getting more reliable bonds and guarantees on my money. Is that fair to say?
Yeah, and you'll see people flee to safety like bonds when the market gets a little crazy, like it has in the last couple of months.
Right.
And so that's inevitably going to happen. Same with gold. And we're going to do a whole episode on gold coming up because I think that is a very hot topic, especially lately. Gold's done really well in the last year, and people keep coming to me asking, should we buy it? What are your thoughts? So we're going to do an episode on gold and our belief, or kind of some numbers behind it to help you understand that as an investment, or should it just be better as jewelry for you?
I'm excited to hear because I have plenty of questions for you, but you never showed me your pile of gold bricks in your house. So I'm curious where you're keeping it all. But
I ain't got none. No gold bricks here, and no
well,
gold watches either. Maybe one day.
Yeah. Well, I'd like to end on this topic again. Hopefully, they got a better understanding of what we are talking about with asset allocations and equities versus fixed incomes. Like, what are we talking about? So hopefully that gives you a little bit clearer of a picture. Pick up the phone. We're always here. But I am curious now, turning the 401k hat back on, or just the retirement plan perspective. But I don't know what the statistic is. I should probably Google it with my fingers here real quick. I think the statistic was like over 75% of retirement plan assets are in or already in target date funds, right? And I was just curious because I think you can ask 10 advisors and get 10 different answers about takes on target date funds specifically. But why I think this is a pertinent topic is if our viewer is in a retirement plan, there's a good chance that they're just invested in a target date fund right now, right? And I think I'll give you my insight and pick me apart, tell me where I'm wrong. But a lot of times in 401k plans, it's not really designed for investors per se. It's more just to set up a retirement nest egg, right? So you're not chasing short-term gains. You're forcing yourself to put a little bit out of your paycheck every time you get paid to go into this retirement egg. But you still are investing that money. So assuming that majority of participants in 401ks or qualified plans are not sound investors, the DOL likes this concept because a lot of these money managers and fund companies out there created these target date portfolios where, based off of your age and your target date of retirement, it's going to skew this equity versus fixed proportion. So as you get older and you get closer to retirement, it's going to skew more to the fixed income sleeve than it would for equities, kind of like what we just discussed. But there's a lot of, and I've seen it a couple of times where, like, great story, but should I really be having any fixed income when I'm 30 years old, 35 years old? And I think you answered my question prior by saying, well, it all really depends on what you're trying to do with your retirement and cash at hand. But I mean, what is your thoughts on that, Sean? Like, again, I think there's probably pros to the fact that, like, not most participants in 401ks understand investments. So, hey, if you have a fund company that's kind of monitoring the underlying portfolios and skewing it from company stock to fixed income as you get older and so forth, that's a pretty cool concept. But are people missing out if they're just kind of relying on their 401k or qualified plan and saying, well, if it's what the plan offers, it's probably a good thing? What are your thoughts on that?
Dude, I love the question because I think you're probably right. I think it's closer to 80% of people just put it in target date funds. And I don't hate them, but I don't love them. They're very
Good to know.
The tough thing with 401k plans is it's sometimes people don't have any better options. Sometimes there's just not enough to choose from to build a good portfolio for somebody. So the target date fund is great at that. A target date fund will have asset allocation in stocks and bonds. Typically, the farther out your retirement is, the further that date is. Now you're probably closer to 2070. It's probably the longest you'll see out there. So that should be like very heavy stocks, like majority stocks. I would say 90 to 95% stocks. And as you get older, or that date gets closer, they will systematically dial down the risk or the amount of equities that you own without you even having to think about it.
Bingo.
So I think the target date funds are great for people who, one, are just getting started. Like, hey, you just got a 401k plan. Great. You're young, pick the farthest date out target date fund you can, put money into it. And then when you start building some serious wealth in that 401k, and when I mean serious, I mean anything probably over 100 grand, 200 grand, like, talk to somebody, friends, family, financial advisors, somebody who knows what they're doing on the investment space, and have them look up that fund and see what it's like. The amount of people that come to me who've been in target date funds for a decade plus, those target date funds do get, in my opinion, too conservative too quickly. I'll see 40-year-olds that have, 70% stock and 30% bonds. And I personally think that's way too conservative.
Right on.
That's something that I put, 65-year-olds in if they can handle that, or 70-year-olds that can handle that kind of thrill level. So yeah, I think It's again one of those amazing financial situations where there's no one size fits all. It's all very specific to that plan. If they don't have any better options, it is what it is. If they do, and we can build somebody a good portfolio with the other funds available, but most people would just get that enrollment email. It kind of highlights that fund for them and they just go with it. They don't know what they're doing. They're just kind of filling out this info all alone and they just put their money in it. And they usually don't think, to have somebody review it,
Well, my company's offering it. It must be good, right? So I think you hit the nail on the head with that. And I think what's also important to understand just from my point of view is a lot of times these what we call custodians or record keepers or vendors that are holding your 401k dollars, I shouldn't say incentivized, but a lot of times they're offering target date funds that their own company has ties to where they make some additional revenue behind the scenes. So although from the perspective of the DOL, like, no, the plan offers target dates, we're checking the box. Well, what is that target date fund? What's the name of that target date fund, right? So I think even though it may be a sound retirement investment option for a lot of participants, don't just assume it's the right one just because it's being offered, right? Fact check and double check and say, well, why is it this target date fund? Is it fitting my goals? And you may not know those answers, but you can sure as heck call someone that does and talk through that. So I just think it's important for viewers that are in retirement plans that don't care about investing and I do 5%, I get a 5% match. And I think I go into this thing called a target date fund. Don't just assume that that's your only option just because it's in your plan and that's what you started out with. There is plenty that you can do.
Yep. And understand they call it a glide path. Understand how quickly it gets conservative. Is it 10 years? Every 10 years they're dialing it down. Every 5 years they're dialing it down. When I say dialing it down, I mean adding more bonds, reducing your stock exposure. Sometimes that messes people up too, who go into a retirement plan at 40 or 45 and their target date fund is the 2055 or 2060 and they don't pick the most aggressive one. And now they're in a fund that's 70% stock, 30% bonds or 60-40. And they're wondering why, they're only getting 6% when the market's up 10. So yeah, these are definite mistakes that people make. And it's simple just to interview a financial advisor. Maybe you already have one. Make sure if you do have one that you're reviewing your 401k together every year. That is what we do once a year. Is give me your 401k statement. Let me see what it's in. Checks the box. Good. No, it's not good. Okay. Give me all your investment lineup and I'm going to put together a better portfolio if I can, or pick a different target date for you if I can. So again, just financial health, like make sure you're getting that physical for that every single year, because that's where the bulk of most people's wealth is.
Well said, man. And that's really what I had for today, which is we throw out fixed and equity and asset allocations, and you're going to hear target date funds. And if you're working in and you're contributing to a retirement plan, fact check me, see what you're invested in. If you never really looked at it before, I'm willing to bet you're probably in some type of target date fund, right? So Sean, I always appreciate you and just your lens and just kind of explaining how these things work, man. So I always appreciate you.
Thanks, man. I appreciate that. And yeah, for you listeners out there, don't let a decade plus go by and put away, 15, 10% of your paycheck every month into something that you have no idea what it's doing. So, yeah, man, good conversation. I hope that kind of does reset just some basic understanding. And if not, we're just going to keep mentioning them again as these episodes go on. Try it again. And everyone will become a professional about equities and bonds and the target date 401k space as these years go on with us together at the driver's seat.
Awesome, man. Well, thanks as always, Sean.
You got it, buddy. Have a good night. We'll see you next week.
Yes,
Love
sir.
you guys. Appreciate it.
Take care, guys.
See ya.